Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market dynamics, semiconductor momentum, macroeconomic pressures, and sector divergences. This video presents a direct informational narration of the source document, so let's dive right into the data. Right now, we're observing a fascinating dynamic in the markets. The broader indices, like the S&P 500 and NASDAQ, are pushing to new historical highs. But beneath the surface of this rally, which is largely being driven by concentrated momentum in semiconductors, we're seeing underlying macroeconomic pressures and some pretty significant sector divergences.
Here's a quick look at how we'll break this down today. First, we'll cover semiconductors and market breadth. Second, we'll look at the latest producer price index data. Third, we'll review Treasury auctions and bond risks. Fourth, we'll examine Microsoft and sector divergence. And finally, we'll wrap up with upcoming macroeconomic catalysts.
Starting with Section 1, Semiconductors and Market Breadth. We are beginning here because the semiconductor sector is absolutely leading the current market structure. Now, despite NVIDIA's impressive 6-day consecutive rise, jumping in at current levels actually presents three distinct short-term risks that you need to weigh against its long-term forward valuation. First off, technical indicators are currently showing an overbought status that generally needs downward repair. Second, there's uncertainty regarding the outcomes from the upcoming US-China head of state meeting. And third, we have an imminent earnings report next week, which carries a historical 50-50 probability of volatility. What's really striking right now is the sheer divergence in market breadth. On one hand, you have the S&P 500 hitting new historical highs, heavily driven by a concentrated handful of mega-cap tech and semiconductor stocks. But look at the actual components. In a single session, 326 stocks declined. Even more concerning, the number of stocks hitting 52-week lows has actually increased to 9% of the total index. It's a very split market.
Now, record capital continues to flow into 3x long semiconductor ETFs on the dips, but you've got to watch the technical support levels closely to confirm any kind of structural breakdown. For the SOX index, the support level to watch is 4890.7, and we need an effective break below 4895.0 to end the current squeeze. For the SMH ETF, support sits between 530 and 552. A drop below that 530 mark is what would officially confirm a top.
Moving on to Section 2, Producer Price Index Data. This April PPI data completely exceeded expectations, and it triggered a very clear hawkish sentiment across the bond markets. When we look at the numbers, it's a clean sweep of beats. Overall, PPI came in at 1.4% month-over-month, pushing the year-over-year figure to 6%, well above the 4.9% expected. Core PPI, which excludes food and energy, hit 1.0% for the month and 5.2% for the year, again beating the 4.3% expectation. Even supercore PPI accelerated to 0.6% month-over-month and 4.4% year-over-year. This uniformity tells us that inflation stickiness is broad and extends well beyond just food and energy. So what does this actually mean for consumer data? The transmission of these producer costs into consumer metrics like CPI and PCE isn't instant. It takes roughly 3 months for the short-term impact and anywhere from 3 to 7 months for full transmission. Because of this timeline, we are looking at guaranteed upside pressure on CPI and PCE toward the end of the year. As a direct consequence of this sticky inflation, the conditions for rate cuts have become extremely harsh. The market is now pricing in a 30% probability of a rate hike in 2026 and a rather significant 50% probability of a hike by 2027.
Let's transition to Section 3, Treasury auctions and bond risks. This shift in rate expectations showed up immediately in the bond market. 5%. For the first time since August 2007, a $25 billion 30-year Treasury bond auction actually crossed a 5% issuance yield. That is a historic threshold. To put that into perspective, let's look at the historical precedent from August 2007. Back then, the 30-year Treasury yields crossed 5%, while the S&P was trading near its highs. Interestingly, the S&P 500 continued rising for about 2 more months, peaking in November around 1,500 points. However, following a collapse in bond quant trading, the index plummeted 57% over the next year and a half. While direct replication isn't guaranteed today, it shows exactly how bond market shocks can transmit to equities with severe consequences. With the 30-year yield already steady at 5%, the critical threshold we need to monitor right now is the 10-year yield. If the 10-year crosses approximately 4.65%, the risk of a direct impact and shock to the stock market significantly increases. Section 4, Microsoft and sector divergence. The macroeconomic tension we just discussed is creating some severe sector divergences, and we can clearly see this in the software and retail spaces. Take Microsoft, for example. The stock has fallen for 4 consecutive trading days on shrinking volume as capital rotates heavily into semiconductors. But structurally, its long-term valuation remains highly cost-effective among the top 7 tech components. Looking at forward valuation targets, we see a range of 401 to 538 for June 2026 and 441 to 592 for June 2027. Key entry support sits right at the 400 mark, though it's recommended to hold reserve capital for the 375 level. Now, regarding the OpenAI lawsuit, there is a clear distinction between the short and long-term impacts on Microsoft. In the short term, it does create negative sentiment due to the potential loss of future equity gain windfalls. However, the long-term financial impact is actually minimal because their initial investment has already been recouped. And we're tracking weakness elsewhere too. Netflix recently broke its support at 87. While it's rebounding, it faces heavy resistance between the 87 and 100, with lower support down at 77. And looking at rate-sensitive cyclical areas, the S&P retail sector took a major hit, dropping 6.7% cumulatively over just 3 trading days. Finally, Section 5, Upcoming Macroeconomic Catalysts. Let's look at the events that could dictate the market's next structural move. In the short term, the market is awaiting official joint statements from the U.S.-China head of state meetings. On an individual stock basis, Boeing confirmed a breakout above 240, targeting the 300 level. AMD is consolidating at its highs, and Tesla is showing some mild after-hours momentum. Looking a bit further ahead, a major catalyst will be the June 16th to 17th FOMC meeting. Incoming Fed Chair Walsh is set to host this crucial quarterly meeting, which will feature brand new economic projections and updates to the dot plot following highly partisan Senate confirmation voting. So, as we evaluate these upcoming catalysts against those rising bond risks, it really brings us back to this quote: "A schizophrenic market where a shrinking number of stocks drag the indices higher while an expanding number quietly hit 52-week lows." It certainly leaves us wondering, how long can the broader indices rely on this concentrated momentum to mask the macroeconomic pressures underneath?